Welcome to Tesla Deep Dives.
The pivotal topic on our agenda today is the Production Plateau, decoding Tesla's Q4 delivery miss and the erosion of the hypergrowth narrative.
Welcome to the deep dive on the seismic shift shaking the world's most valuable automaker. Tesla's latest quarterly numbers didn't just miss Wall Street's mark, they delivered a direct hit to the long-cherished hypergrowth narrative, forcing a fundamental reevaluation of its trillion-dollar valuation.
The core issue is painfully clear. The Q4 delivery figure landed at approximately 418,227 vehicles, falling short of the consensus estimate of roughly 426,000. More critically, this figure represented a sharp 16% decline year-over-year, compared to the 495,570 units delivered in Q4 of the prior year, an unprecedented reversal of historical trends. This quarterly decline cements a larger structural worry. The company logged a second consecutive annual delivery decline, ending the year with approximately 1.63 to 1.64 million deliveries. This persistent plateau signals that the aggressive price cut strategy, which has seen the Model Y's cost slashed numerous times, is reaching the limits of price elasticity, failing to offset the effects of rising competition and economic headwinds like high interest rates. Simultaneously, the competitive landscape delivered a fatal blow to the volume dominance thesis. China's BYD officially surpassed Tesla to become the world's largest electric vehicle maker by volume, reporting 2.26 million fully electric sales for the year, outpacing Tesla's 1.63 million annual total. This shift validates the argument that global EV manufacturing is rapidly commoditizing, creating a high-volume, low-margin environment for traditional auto sales. The bullish camp, led by longtime supporters like Wedgebush's Dan Ives, has immediately pivoted the narrative away from auto volume. Ives commented that the deliveries were better than whisper numbers and that all eyes are on AI into 2026, suggesting the street should view this as demand stabilizing. This view maintains that Tesla is not an automaker, but an AI robotics company that happens to sell cars, justifying the high valuation based on the future earnings potential of full self-driving, FSD, and Optimus. Conversely, the skeptical narrative argues the problem is demand saturation, not just a logistical hiccup. Morgan Stanley analyst Adam Jonas explicitly stated that the miss reflects a relatively aged product and increased availability of lower-priced competition globally. This viewpoint suggests the current vehicle lineup, dominated by the Model 3 and Y, can no longer sustain the valuation multiple, and the company is facing an irreversible loss of market share without a new, high-volume, low-cost model immediately available. The market reaction was swift, volatile, and highly visible. Following the announcement, the stock dropped between 3% and 6% in pre-market and early trading, contributing to a multi-day slide that wiped over 10% off its share price. On platforms like X, sentiment remains highly polarized. Traditional financial media focused on the immediate profit margin implications, while community investors largely echoed the bull case, emphasizing the strong performance of the energy segment. The energy business did provide a much-needed bright spot for the bulls, reporting 14.2 gigawatt-hours, or GWH, of energy storage deployment in the quarter, exceeding estimates. This quantitative growth in Megapack and Powerwall deployment is now being framed as the new hypergrowth area, providing a non-auto, high-margin revenue stream that supports the company's transition from a cyclical manufacturer to a diversified energy/technology platform. In synthesis, the market is currently caught in a tug-of-war between two opposing valuations, the AI-powered high-multiple tech stock and the cyclical, margin-pressured automaker. The delivery miss has undeniably eroded the confidence in the auto-volume hypergrowth thesis. The currently dominant market sentiment is one of caution. The stock's future now hinges less on the proven growth of the Model 3 and Y and more on the successful execution of speculative projects like FSD and Optimus, effectively resetting the acceptable risk premium. Moving forward, investors must monitor three critical metrics. First, the 2026 full-year guidance for production volume. Second, the Q1-Q2 gross margin to see if price discipline returns. And third, the specific ramp rate of the Cybertruck and any concrete details on the low-cost vehicle, as these are the only factors that can realistically reignite the volume growth necessary to escape the production plateau. Let me know what's your thoughts and leave your comments. Thank you for joining us for this crucial deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.